Section 1. Unlocking Financial Health Ratios. Our key. Investors, listen up. Today, we're diving into the world of financial ratios, the secret sauce to smart investing. Want to know the secrets to smart investing? You gotta understand financial ratios. These ratios are the backbone of financial analysis, giving you a clear picture of a company's performance. These magical numbers unlock a company's financial health. They provide insights into various aspects like profitability, liquidity, and solvency. They show you how well a company is doing. By examining these ratios, you can gauge the efficiency and effectiveness of a company's operations. Think of them as a financial report card. Just like grades in school, these ratios tell you how a company is performing in different areas. By analyzing these ratios, you can make informed decisions about where to put your hard-earned money. It's like having a roadmap to navigate the complex world of investing. Financial ratios are powerful tools. They break down complex financial data into understandable metrics. They help you compare different companies. You can see at a glance which company is more profitable, more efficient, or more financially stable. You can see which company is performing better. This comparative analysis is crucial for making investment decisions. They also allow you to track a company's performance over time. By looking at trends, you can see if a company is improving or declining. This helps you spot trends and make better predictions about the future. Understanding these trends can give you a competitive edge in the market. Don't be intimidated by the numbers. They're here to help you. With a little practice, you'll be able to read and interpret these ratios like a pro. These ratios are like financial detectives. They dig deep into the numbers to reveal the true story of a company's financial health. They reveal hidden clues about a company's profitability, efficiency, and overall financial stability. These clues are invaluable for making sound investment choices. Understanding these clues can give you a big advantage in the market. You'll be able to identify strong investment opportunities and avoid potential pitfalls. Remember, knowledge is power, especially when it comes to investing. The more you know about financial ratios, the better equipped you'll be to make smart investment decisions. So buckle up and get ready to dive into the exciting world of financial ratios. With these tools in your arsenal, you'll be well on your way to becoming a savvy investor. Section 2. Cash is king. Liquidity ratios and you. Let's talk about liquidity, people. It's a fundamental concept that every business, big or small, needs to understand. In the world of finance, liquidity means having enough cash on hand to pay your bills. It's the lifeblood of any business, ensuring that operations run smoothly without any financial hiccups. It's like having enough money in your wallet to cover your daily expenses. Imagine going out for lunch and realizing you don't have enough cash to pay for your meal. That's a liquidity problem. Two important liquidity ratios are the current ratio and the quick ratio. These ratios help us gauge a company's ability to meet its short-term obligations. The current ratio tells you if a company has enough current assets to cover its current liabilities. It's a straightforward measure of financial health. Think of it as a measure of short-term financial strength. A strong current ratio means the company can comfortably pay off its short-term debts. A current ratio of 2 or more is generally considered healthy. It indicates that the company has twice as many current assets as current liabilities, providing a cushion against financial uncertainties. It means the company has twice as many current assets as current liabilities. This is a good sign of financial stability and operational efficiency. Now, the quick ratio is even more stringent. It provides a more conservative view of a company's liquidity. It excludes inventory from current assets. This is because inventory can take time to sell and convert into cash. Why? Because inventory can be harder to turn into cash quickly. In times of financial stress, relying on inventory might not be the best strategy. A quick ratio of 1 or more is generally considered good. It shows that the company can meet its short-term obligations without relying heavily on inventory sales. It indicates the company can meet its short-term obligations without relying heavily on inventory sales. This is crucial for maintaining smooth operations and avoiding financial bottlenecks. Remember, liquidity is crucial for a company's survival. Without adequate liquidity, even profitable companies can face serious financial challenges. You don't want to invest in a company that's constantly struggling to pay its bills. Such companies are at a higher risk of bankruptcy and financial distress. So keep an eye on those liquidity ratios. Regularly monitoring these ratios can provide early warning signs of potential financial issues, allowing for timely corrective actions. Section 3. Profit Powerhouse. Unveiling Profitability Ratios. Now let's talk profits. This is the heart of any business, the ultimate goal that drives every decision and strategy. After all, that's what we're all after, right? Whether you're a small startup or a large corporation, profitability is the key to sustainability and growth. Profitability ratios tell you how efficiently a company generates profits from its sales and assets. These ratios are essential tools for investors, analysts, and business owners alike. Some key profitability ratios include gross profit margin, net profit margin, return on assets, and return on equity. Each of these ratios provides a different perspective on a company's financial health. Gross profit margin measures the profit a company makes after deducting the cost of goods sold. This ratio is crucial because it shows how well a company is managing its production costs. A higher gross profit margin is generally better. It indicates that the company is retaining more revenue after covering the costs of production, which can be reinvested into the business. It means the company is keeping more of its revenue after covering production costs. This can lead to more opportunities for expansion, innovation, and rewarding shareholders. Net profit margin takes it a step further. It considers all expenses, not just the cost of goods sold, including operating expenses, taxes, and interest. It considers all expenses, not just the cost of goods sold. This gives a more comprehensive view of a company's overall profitability. A higher net profit margin indicates better overall profitability. It shows that the company is not only managing its production costs well, but also controlling its other expenses effectively. Return on assets measures how efficiently a company uses its assets to generate profits. This ratio is particularly important for asset-heavy industries like manufacturing and real estate. A higher return on assets is better, of course. It means the company is squeezing more profit out of its assets, making the most of its investments in equipment, property, and other resources. It means the company is squeezing more profit out of its assets. This efficiency can lead to higher returns for investors and more capital for future growth. Finally, return on equity focuses on how efficiently a company uses its shareholders' equity to generate profits. This ratio is a favorite among investors because it shows how well their money is being used. A higher return on equity is generally more attractive to investors. It indicates that the company is using shareholder investments effectively to generate profits. It shows the company is using shareholder investments effectively. This can lead to higher stock prices and dividends, making the company more appealing to current and potential investors. Remember, profitability is key to long-term success. Without strong profitability, a company cannot sustain its operations, invest in new opportunities, or provide returns to its shareholders. By analyzing these ratios, you can identify companies that are generating strong profits and using their resources efficiently. This insight can guide your investment decisions and help you build a more profitable portfolio. Section 4. Debt Dilemmas, Navigating Debt with Ratios. Debt can be a double-edged sword. While some debt can be healthy for growth, too much debt can be risky. Debt ratios help you assess a company's financial leverage and its ability to manage its debt load. One important debt ratio is the debt-to-equity ratio. It compares a company's total debt to its shareholder equity. A high debt-to-equity ratio indicates a higher level of financial leverage. This can be risky, especially if the company faces economic headwinds. Another crucial ratio is the interest coverage ratio. This ratio measures a company's ability to cover its interest expenses with its earnings. A higher interest coverage ratio is generally better. It means the company is more capable of meeting its interest obligations. Remember, too much debt can be a red flag. It's important to analyze debt ratios carefully to understand a company's financial risk. You don't want to get caught holding the bag if a company can't handle its debt. Section 5. Efficiency Edge, Streamlining with Efficiency Ratios. Efficiency is all about doing more with less. Efficiency ratios help you assess how effectively a company manages its assets and liabilities. Two key efficiency ratios are inventory turnover and receivables turnover. Inventory turnover measures how quickly a company sells its inventory. A higher inventory turnover is generally better. It suggests strong sales and efficient inventory management. Receivables turnover measures how quickly a company collects payment from its customers. A higher receivables turnover is generally preferable. It indicates efficient credit and collection processes. Remember, efficient companies waste less. By analyzing efficiency ratios, you can identify companies that are optimizing their operations and maximizing their resource utilization. That's a recipe for success. Section 6. Market Magic: Decoding Market Ratios. Market ratios provide insights into how the market values a company. They relate a company's stock price to its earnings, sales, or book value. Two commonly used market ratios are the price-to-earnings (PE) ratio and the price-to-book (PB) ratio. The PE ratio compares a company's stock price to its earnings per share. A high PE ratio can indicate that the market has high expectations for future growth. The PB ratio compares a company's stock price to its book value per share. A low PB ratio can suggest that the stock is undervalued. Remember, market ratios are influenced by market sentiment and investor expectations. While they can provide useful information, it's important to consider other factors before making investment decisions.